Yeah, we'll stick with the financials here because big banks, turns out, just aren't lending like they used to. That's the main takeaway from a brand new piece from our next guest, calling on regulators to pay attention to the risks associated with shrinking consumer loan balances and not just banks' balance sheets. Joining us here on set, Meredith Whitney, of Whitney Advisory Group founder, CEO. Thank you for coming in, Meredith. It's good to see you again. And this is your bailiwick. This is what you're known for, is the analysis around banks. So what did you find when you dove into the lending?
Well, I took a big step back and looked at bank balance sheets over the last 10 years, 15 years. And what you see is they've transformed. And you also see which banks have had clear strategies and which banks have kind of muddled their way through. And what you see is the banks really got gobsmacked when regulators put the screws on after the GFC. And, of course, they needed to delever. But what's happened is their concentration, their market share of consumer lending has collapsed from 16% in 2012 down to 10%. So three out of the four big banks have shrunk their consumer lending portfolios. And that was their livelihood. That's where they got fee income. That's where they got high-yielding loans. And they haven't really recovered from an earnings perspective. Now, Bank of America has drastically cut costs, so it's been able to do better than others. But Citi and Wells, that have also cut their consumer lending portfolios, have really have yet to find their way, right? So fee income, non-interest income for them has collapsed. Assets or even non-consumer loans have shrunk, and they can only buy back so many shares. So I think what you're seeing is lending moving out of the bank balance sheets into non-bank financials. That's clear. Shadow banking, and it's very reminiscent of what happened or all the growth in non-bank lending that happened during the 90s. But for the banks, I thought this was fascinating in terms of how much out of the lending practice the banks are.
Yeah, and I guess few implications of that. One is just long-term profitability of banks. And whether that will ever return. Yeah,
so what's happened is, again, the peak earnings year was 2006. Again, there was aggressive lending, and we don't want to go back to the ways, but what they've become has been big securities holders for government issues, for cash, for very razor-thin margin securities. And that's not really a long-term plan. Now, with the regulatory capital increases, profitability will continue to go down. But again, J.P. Morgan is the outlier with this. They've been growing consumer loans. They've been growing commercial loans. They've done an unbelievable job at growing their credit card business. Bank of America has actually shrunk their credit card business, so it's half of what it was in 2006. Citi has just, again, not found its way in terms of what direction it will come in terms of the strategy. Interestingly, Wells Fargo has increased expenses by 14%, while revenues have fallen by 14% over a 10-year time period. So it doesn't look good for the big banks.
I was going to say, between Wells and Citi, who's done the worst job on operating expense?
Wells clearly has done the worst job at operating
Even with
expenses.
all the promises behind efficiency and Charlie's mission and so forth.
It's sadly, over the last 10 years, they've, as I said, increased expenses by 14%, while revenues have declined by 14%. So he's got a tough road ahead.
So what do the regulators do about this? Because it's broader than just bank shareholder performance and performance. Yeah, it has implications for the economy. Clearly.
For certain. And I think that today's downgrade and the regulators now going after banks that are $100 billion and up is only going to put more pressure on the banks to become effectively securities holders. So the good thing is the big banks have a lot of deposits. Deposits over the last 10 years have increased 81%. And the deposits across the board have increased $4.5 trillion in the last 3 years alone. So it's been they're awash with capital. But I think more and more the banks, all of the banks, are going to become securities holders and less lenders. So that means, opportunity will arise and you'll see shadow banks coming in and lending.
Private credit is booming.
But you also see a lot of consumer lenders like you did in the 1990s come around. And I don't think that's good for the system. I don't think it's good for the system. I can tell you from living in D.C., the regulators are not in. They're not working in office. There's no dynamic thinking. They're checking boxes. And I think, in the next 10 years, we'll see what the unintended consequences of these actions are.